Brief outlook for 2021, online here to stay, more space being converted to logistics use. Stores suitable for discounters are the hottest area of the market in terms of rental growth. And as discounters continue to increase store sizes, we see continued upward rental pressure on the smaller supermarkets operated by the Big Four, and all at the same time continued pressure on margins as the Big Four compete with the discounters.
What we do know is there is a high range of investors seeking grocery assets with a range of new requirements, whether it be for long incomes with RPIs or now shorter income opportunities with open market value reviewed stores. But after 2 record years of investment volumes, it's anticipated that a lack of stock is going to be the key issue in 2021. We do expect that we'll see some smaller transactions as more Lidls and Aldi's come online, but I anticipate volumes will be in the line with a 10-year average of about 1.3, 1.4 billion. A lack of supply will also mean only one thing: yield compression. However, after a significant movement in the yields in 2020, it will be interesting to see if this can be maintained.
Sainsbury's have focused very much on convenience, but also their new smaller neighbourhood stores, and we predict there's going to be more of those coming out of the ground later this year and into next year. And Tesco's name have begun to be heard on some smaller stores as well. It's an interesting dichotomy, I think, because for all of the Big Four supermarkets, they've actually got very mature networks where there are quite a few overlaps, not just with perhaps their own stores, but as stores have opened, new Aldi and Lidl stores open, and a kind of proliferation of things. So it's quite natural there probably will be more closures of some of those bigger, older stores that perhaps aren't really in some ways fit for what consumers are after now. And it's a bit of portfolio evolution that we see in most of the rest of the retail market, but perhaps hasn't happened in the food store market for a long time. It's now more about profit than it is about turnover and just market share as it was a few years ago, perhaps. So I do predict we're going to see some more closures of these usually bigger stores. But interestingly, Aldi, unlike Lidl, are rolling out their click and collect operation quite widely. And what that's doing is actually putting pressure on site size as opposed to store size at the moment, because they need that extra space on site so that they can cater for click and collect. I think, however, the pandemic's brought something interesting in that these stores are actually quite small and quite tight in terms of the space they have inside. They're not as generous as the other big supermarkets. And I think that, combined with the ability to fulfill any click and collect or other online operation, might keep pushing that store size upwards in time.
I can certainly see us continuing to build out new stores, but as Greg touched on, conditions need to be right, locations need to be where we know we want to be, and the micro position of the site in itself needs to be absolutely spot on. So we'll continue selectively, but positively. And I think it's worthwhile touching on the existing estate, Duncan, and some of the work that we were doing on that last year, again, with the customer in mind. And we want to keep our estate in as fine as fettle as we can. We have a rolling program of refurbishments. We reached our 350th store last year, for example. And the purpose of that is, yes, keep everything fresh, keep it relevant to customers, but really to enhance our fresh food Market Street credentials, but also introduce new categories to our customers in the shape of clothing through our Nutmeg brand, gardening, homewares, those sorts of categories.
Really what you can't do overnight is build completely new online departments or create dark stores. That just won't happen. But actually what some of the other limitations of the pandemic have meant is, for example, our cafes were forced to close, or our delicatessen counters, and that space in store we've been able to repurpose and use for online activity. Online needs that space internally to process, stage, dispatch the orders. So we've been really creative with our space in store, and then also creative with our space outside of the store and more broadly on the site. So the car parks, that's where we've opened over 200 new collection points. We also need space to hold an increasingly large fleet of vans. So that's become really important as well. But for me, actually, it's not all about supermarkets. So convenience is really playing a role in this as well. If we take Sainsbury's Chop Chop proposition, which is in hour delivery, that's been a great way to allow people to shop online, and that's fulfilled predominantly out of convenience stores. So it gives a new digital role for our convenience stores, and partnership recently with Uber Eats and Deliveroo, again, they are fulfilled from smaller convenience stores as well.
The major dynamic that's happened there during the course of the year is people have been shopping a lot less frequently because the government told us to stay home. We wanted to stay home, but when we've gone, boy, have we increased how much we're buying on average. And so those basket sizes have shot up. And since an initial flurry in March and into April, since then, we have seen a very, very gradual return towards more normal patterns on both those metrics of basket size and the number of trips we're making, but we're nowhere near normal yet. And it goes up and down a little bit with the various lockdown conditions that the governments in the United Kingdom impose. So that's the direction of travel. But the two winners out of it really were convenience and then online. You can split out already in the data what's happening in convenience and what's happening online. So take convenience first. Its market share jumped massively in April and May. People didn't want to travel very far. There was stocking problems in major supermarkets, and people were combining trips on their daily exercise to walk to the convenience store to get some things, and perhaps they didn't have to queue to get into that small store. So that shot up. But since then, convenience has fallen out of favour to a large degree, and its market share is pretty much back where it was.
Often people do overlook that, yes, sale and leaseback, we all know, but there are other financing options for the CFOs of these big companies, whether it's securitization, other forms of monetization, which they can, the way borrowing and cheap debt is at the moment, there are other options to them than a traditional sale and leaseback. I think often the bigger operators will have a mixture of these ideas, and at the right point in time, they'll effectively hit the execution button and go down one of those routes.